Hello and welcome back to our ID Big 50 countdown. After walking you through the list with our two previous videos, we're ready to reveal the top 10. A big thanks to our platinum sponsor BigCommerce for their support of the Big 50 list. And if you haven't yet, please check out our first two videos at the links below so you can learn more about the companies ranked 50 through 11. We have some interesting insights ahead from industry experts. We're also joined in the studio by ID editor Andy Szal for some deep dives on a few of our top 10 companies. So let's get underway. The number 10 company on this year's list is Valin Distribution of Belmont, North Carolina, a distributor that's laser focused on integrated supply and has made headlines of late. Valin told us two strategic acquisitions, Wesco Integrated Supply and Eastland Engineered Supply, secured Valin's number one position in the integrated supply sector. The Wesco addition closed in April of 2024, and CEO Chuck Delf said at the time that as a combined company, we will be the partner customers and suppliers turn to for innovative and sustainable solutions, providing technical product knowledge, deep experience with supply chain solutions, and excellent customer service. Valin told us that data and technology investments remain a high priority to enable the company to effectively and efficiently service its customers, adding, quote, Valin continues to focus on expanding share of wallet and new logos in the key verticals core to our strategy, coupled with enhanced margin initiatives to maximize profitable growth. MSC of Melville, New York comes in at number 9 with $3.8 billion in annual sales. According to MSC, its business strategy is based on helping customers become more productive and profitable by reducing their total costs for purchasing and using metalworking, MRO, Class C consumables, and OEM products and services with an emphasis on its technical expertise. Key acquisitions for MSC in 2024 included Car Industrial, the intellectual property assets of Schmitz Manufacturing Research and Technology LLC, Aptex, and Premier Tool Grinding. MSC faced some critical challenges in fiscal 2024, resulting in declines in both sales and margins. That said, CEO Eric Gershwin told us, quote, during our fiscal fourth quarter, we made important progress in our mission-critical strategy despite a challenging macro environment, particularly in heavy manufacturing. We sustained momentum in our high-touch solutions, made solid progress on our web enhancements, restored gross margin stability, added to our productivity pipeline, and generated strong free cash flow. MSC has not been alone in navigating some tumultuous variables specific to the industrial economy. We recently spoke with Taylor St. Germain of the economic research and consulting firm ITR Economics about how significantly these economic winds have been shifting for industrial distributors, starting post-COVID and into 2024.
You know, while GDP was doing just fine in 2024, the situation for industrial manufacturers and distributors was a lot more challenging because we were coming off that big inventory build throughout COVID, and then demand fell off in 2024. So a lot of these distributors were left with elevated inventory levels, and the demand wasn't there to drive growth in the business or get rid of that inventory that they spent all that time building. So I call it a little bit of an inventory hangover is what 2024 was, but it was a perfect storm because industrial production is one of the major series that we watch and correlate to distributors' businesses. And that was actually negative year over year through all of 2024. So it created a very challenging environment. Like I said, 2021 to 22 was all about building inventory, distributors trying to keep up. And then in late 23 and especially 24, that demand fell off. And so distributors were stuck with elevated inventory levels, and the demand just wasn't there to drive the growth in the business.
Applied Industrial Technologies of Cleveland is number 8 on this year's list. Here with a glimpse into Applied's 2024 is Andy Szal.
Applied Industrial Technologies remains at number 8 on the Big 50 after its 2024 fiscal year sales edged up to nearly $4.5 billion, despite a larger than expected slowdown in its end markets that led to a dip in organic sales in the final quarter of the year. The Cleveland-based motion, fluid power, flow control, automation, and maintenance distributor, whose fiscal years wrap up in the middle of the calendar year, acquired South Carolina's Bearing Distributors Incorporated, Kingro Industries on Long Island, and Grupo Copar in Mexico during that span, which bolstered the revenue total back narrowly into the black in the last quarter of the fiscal year. Following the close of that year, the company added New Jersey's Total Machine Solutions and Ohio's Stanley Proctor, and reached a deal to add Illinois-based IRIS Factory Automation. And most notably, it made one of the industry's blockbuster recent acquisitions. In late December, Applied closed on its purchase of Hydradyne, a longtime provider of fluid power products and the number 43 company on this countdown. Applied expects the latter deal to contribute $260 million to its annual revenue, and to add 33 locations across the Southeast to its footprint.
Whitecap is our number 7 company, a distributor that's been objectively busy with acquisitions in the past year. To give you some perspective, between the publishing of last year's report through the end of calendar 2024, Whitecap announced 8 acquisitions. Among them, Whitecap added footprint in safety and specialty tools, even an equipment rental business. So far in 2025, Whitecap has notched another 8 acquisitions, a level of activity that points to the varied response we're seeing from the industry. Some wait and see, some aggressive. While challenges often tend to be the focus, many distributors have become adept at leveraging suboptimal conditions to generate new opportunities, especially when it comes to M&A. So what macro trends are nurturing these opportunities for distributors? Justin Stile, partner and co-head of the North American transaction team for Middle Ground Capital, recently shared his perspective on this.
Middle Ground as a firm are big believers in North America distribution as well as manufacturing. And so we're often cognizant of nearshoring and reshoring trends and developments. And we've been focused on those for a number of years. This current administration and some of the tariff impact in the markets, I think, is causing people to even accelerate nearshoring and reshoring plans. A lot of what is going on came out of what we learned in the pandemic, where people would run to the far reaches of the earth to save costs. And then we found out when a shock like the COVID-19 pandemic happens, there's a lot of risk in a dispersed supply chain. So you're seeing kind of a regrounding and buyers wanting to be closer to their vendors, and there being just less risk and less time in that supply chain. And so that is significantly benefiting not only distributors who can source locally, regionally, but also manufacturers who are producing for those distributors closer to where the ultimate customer is. So I would say that we are seeing a lot of opportunity in North America right now as a result of buyers of products wanting to work with distributors who have a tighter supply chain, more local, more regional sourcing.
At number 6 on this year's Big 50, we have Core & Main, who jumped from $6.7 billion in 2023 sales to $7.4 billion in 2024. The success for this distributor has carried over so far into 2025, with the company reporting record first quarter results in June. Core & Main was also named to the Fortune 500 list for the first time in its company history. 2024 brought more than a dozen acquisitions for Core & Main and a few new branches. Earlier this year, the company announced that after nearly 2 decades with Core & Main, CEO Steve LeClaire would move into the role of executive chair, succeeded by CFO Mark Witkowski. While many distributors generated successful sales gains in 2024, it can be difficult to look back without applying the current context of uncertainty. And for many distributors, we hear aggressive growth objectives slightly tempered by the unknown of a fluctuating tariff environment. And there may be more challenges to come when it comes to pricing. Here's more on that from Taylor St. Germain from ITR Economics.
Well, in the first half of 25, as we were coming out of 24, we started to see the momentum build from a demand perspective again. So we were in what we call the recovery phase of the cycle, where we're not necessarily positive, but we're seeing the growth rates get less negative, highlighting that the demand's coming back. And we were very excited going into the first half of the year because it looked like a year that was going to be characterized by increasing demand for these distributors. And then the uncertainty with tariffs came in, and it caused everyone to basically pause, pencils down, sitting on their hands, because everyone was just worried about the path forward. So it extended some of that negativity into the first half of this year that we felt wouldn't have otherwise been there. And so after all of this up and down of handling inventory levels and having elevated inventory to having decreasing demand, 25 looked like the year where things were going to get quote unquote back to normal. But then these distributors were faced now, as they're trying to pick up inventory again, inventory that's subject to tariffs, as well as the uncertainty around the economy that caused a lot of folks to pause their spending. We didn't see much inflation on the producer side in the first half of 25. And even still today, the PPI, which I'm sure many folks are aware of, the Producer Price Index, it's only up 1.4% year over year. So there's not all this crazy price rise that's going on right now. It was really the uncertainty that caused a lot of the weakness for the first half of the year. Now, I have a feeling that's going to flip as we move deeper into this year. That's our forecast, which is the uncertainty will start to subside, but you're going to have more and more distributors replenishing inventory levels that are subject to tariffs, and that's when the price rise comes in.
Instead of a number 5 company this year, we have a tie at number 4 between Fastenal and Airgas, both reporting $7.5 billion in sales. Starting with Fastenal, we see a company that's edged up about 2.7% in sales, in addition to a jump in full-year gross profit, which climbed from $3.35 billion in 2023 to more than $3.4 billion last year. We recently spoke with CEO Dan Florness for more on Fastenal's year.
We continue to focus on the fundamentals of our business. We try to present ourselves with a great value to our customers. Every day we endeavor to add additional customers to our list of business partners, and we strive to engage deeper and deeper with each of those customers and add wallet share per customer. If you do that every day, in the long term, you'll be successful. In the short term, if you have a handful of customers whose business is down from a year ago, it might mask your growth in a year like 24, or quite frankly, in a year like 23 and 24. But if you're doing that, eventually their business will stabilize and your inherent growth will start to shine through again. So part of what we're seeing is fewer drop-offs in spend from existing customers, and therefore the customer acquisition and the wallet share gains that we have are better shining through as we go through the year. I don't believe anything is coming from actually an improvement in the economy. I believe it's stabilization in our customer base. And our self-help, things we're doing are shining through. And then with tariffs coming into play as we've gone through the year, that's added a little bit to it, but it's primarily a story of business is stable, we're taking market share, and it's shining through.
Our second number 4 company is Airgas, an air liquide company. It appears Airgas is back on the trail, driving consolidation again after a few quiet years paused what's traditionally been a very acquisition-heavy strategy. Airgas pointed to 7 key acquisitions in 2024, including Buckeye Welder Sales, NLR Welding Supply, Inc., Primary Gas Solutions, H-Town Oxygen Company, Sky Oxygen, Inc., Bickett Machine and Gas Supply, and Anco Chemicals, Inc. Company number 3 on this year's list is Win Supply, with a sizable jump in sales. Here with more on that is Andy Szal.
Win Supply has been among the busier distributors on this year's list, and it has no plans to slow down anytime soon. The Ohio company made 4 acquisitions last year: Memphis Waterworks distributor Meter Service and Supply, Phoenix HVAC supplier General Metals, and a pair of North Texas companies, distributor Epic Supply and plastics producer Forge Polyfab. This year, Win Supply has added Kansas distributor Industrial Sales Company and Florida electrical and lighting provider United Lighting and Supply. It also purchased a minority stake in MindXAI, a developer of AI solutions located in nearby Dayton. Win Supply officials said that the latter investment would complement its efforts to modernize its proprietary ERP software. Win Supply has also added about 20 local companies, in which Win Supply partners with local business owners in the past 12 months, and aims to add between 15 to 20 more annually through the end of the decade. In addition, Win Supply reached an agreement to acquire property in Southwest Ohio last year, which could become a new company warehouse complex. Over the next 5 years, the company expects to increase the overall size of its regional distribution network by about 1 million square feet.
Number 2 on the Big 50 list this year is Birmingham-based Motion, reporting $8.7 billion in 2024 sales. 2024 acquisitions for the company included Perfetto Manufacturing and SER Hydraulics, Allied Circuits, LSI Supply Inc., Stony Creek Hydraulics, and International Conveyor and Rubber. The company also added a repair shop in Houston. So far, the company has stayed on an aggressive expansion track in 2025, locking in 2 additional acquisitions and opening 2 new locations in Canada. Motion President James Howe provided us with a little more insight into the current goals of the company, telling ID the following, quote, "Our long-range strategic plan at Motion is built to ensure we remain resilient, committed, and determined to win for our customers, teammates, suppliers, and stakeholders. And it's that dedication to providing the preferred customer experience, energizing our talent, and delivering stakeholder value that allowed us to successfully embrace the economic challenges of 2024 and become a smarter, faster, and better company in the process. As we begin plans to celebrate our 80th anniversary next year, we remain focused on delivering exceptional value by deepening customer relationships, increasing our investment in technology and e-commerce, and expanding our offerings into the areas where customers need us the most. The future is bright at Motion, and we are excited about our continued growth as we meet and exceed the evolving demands of the industrial market. Motion parent Genuine Parts Company also announced that Randy Breaux, former Motion president and current head of North American operations for GPC, would retire at the end of this year. Finally, the time has come to reveal our number one company on this year's Big 50 list. And let's just say it's not much of a reveal at all. For many years running, it's W.W. Grainger, with $17.2 billion in sales this year, up from $16.5 billion in 2023. Grainger's first quarter of 2024 was marked by what it dubbed a slow but steady demand environment. By the end of the fiscal year, however, the company was boasting a respectable net sales increase of 4.2%. In a January statement, Grainger chairman and CEO D.G. Macpherson said that amidst a stable yet muted demand environment throughout 2024, our team delivered strong performance by staying focused on what matters. 2024 also saw Grainger's divestiture of its E&R Industrial Sales subsidiary. The company was recognized by corporate ethics firm Ethisphere as one of the world's most ethical companies in 2025 as well. Looking into 2025, Grainger posted just over $4.3 billion in net sales during the first 3 months of the year, up 4.4% year over year on an adjusted basis. This reflected flat branch and Grainger.com sales, but a sizable 10% jump in what Grainger calls its endless assortment segment, which is comprised of online channels Zorro and Monotero. Q2 also brought higher sales for Grainger, though gross profit margin took a hit of 80 basis points year over year. This prompted Grainger to raise its sales forecast for 25 and drop its earnings outlook and gross margin, citing, quote, tariff-related factors. That's a wrap on our 2025 Big 50 list. We want to thank all of our sponsors, most notably our platinum sponsor, Big Commerce, as well as all of the distributors and experts who contributed the details and insights into producing this list. Lastly, we want to congratulate all of our Big 50 companies. For Andy Szal, I'm Anna Wells. Thanks for joining us, and we will see you next year.